In this week's video, we'll revisit some charts that we covered in detail last week and talk about the possible impact of Cyprus on the financial markets. You can find this text here on our blog, Short Takes. But what spooked the markets on Monday was the Dutch finance minister said that the template for future bank bailouts, or now bail-ins, would be the template that was used for Cyprus. And that means they will go after shareholders potentially, bondholders potentially, and depositors in the bank rather than using taxpayer funds to bail out a bank. It's a radical shift, and if that is the new template, it may potentially cause a correction in risk assets. This is a slide we covered in last week's video where we said Cyprus could be thought of as a precedent for the way that they deal with systemic risk in financial institutions going forward. We covered two possible outcomes for Cyprus. One would be that the market would look at it as a unique situation. The second would be that it was a concerning precedent. We got a little bit of both on Monday. The initial knee-jerk reaction was positive and bullish, but after the Dutch finance minister's comments were published, the concerning precedent market scenario seemed to move to the forefront. So for the remainder of the week, it really depends which way the markets decide to go. We'll keep an open mind and use the charts that we'll cover to monitor risk and help us make better decisions. In terms of risk on versus risk off, not much has changed since we published our last video on Sunday, March 17th. Therefore, the analysis and charts in that video are still relevant. Since the close on Friday, March 15th, relative to the close today on Monday, March 25th, the S&P 500's dropped about 9 points, been relatively flat. TLT, or Treasury bonds, moved a little bit on the bullish end of the spectrum for bonds, and the aggregate bond market ETF over the last 10 calendar days has basically been flat. These are the charts we'll be covering in this week's video. The vast majority of the charts are updates relative to charts we covered in last week's video. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a monthly chart of the S&P 500 index relative to the VIX. Here's the ratio when it's rising. That's risk on. This is the S&P 500 here. Point of the exercise. It appears as if the markets believe that the systemic risk in Europe and the United States has receded and fear has receded. Why? How is that evident? Here's the ratio. You can see here in 2011, S&P 500 divided by the VIX was capped here. We somewhat look at this as a systemic risk cap on the markets. We came back up. Were rejected at the same area in 2012 and again later in 2012. You'll notice when the ratio was rejected at resistance, if I move up here, a correction in the S&P 500 followed. Rejected, correction. Rejected, correction. 2013, late 2012, it's different. We broke above the systemic cap. You can see here in the past when we broke the same line, the S&P 500 did well. Point of showing it, if this breakout holds, it's possible that the stock market surprises on the upside going forward. If the markets look at Cyprus and systemic risk is coming back online now, in terms of the way that they will do bail-ins in Europe instead of bail-outs, and this ratio moves back into this area, then we would be more concerned. This chart says keep an open mind about the stock market exceeding on the upside as long as this ratio remains above this blue line. This is a foreshadow chart that we tweeted last week. You can find it somewhere on Twitter. This is European financials relative to the S&P 500. This looks like a busy chart. Concept very, very easy. When the ratio of European financials relative to the S&P 500 is falling as it was here in 2011, soon thereafter the S&P 500 corrected. 2012, the ratio fell. Soon thereafter, S&P 500 corrected. Later in 2012, ratio dropped right here. S&P 500 corrected. There's been a divergence with European financials being much, much weaker than the S&P 500. We showed this last week and said there's two ways that this divergence can be cleared. Either European financials can strengthen or the S&P 500 can weaken. As long as this ratio is falling, it increases our concerns about a potential pullback in the S&P 500. If you're a stock bull, you'd like to see this ratio turn back up. This chart was covered in detail in a video from last week. You can find the video by Googling Shavako Capital Channel and then find the video Cyprus Stock Market Impact. So we'll just update the chart now. Purpose of the chart was when this ratio, or this line here, which is just the VIX, it's not a ratio, breaks out, the S&P 500 tends to correct soon thereafter. Breakout, correction, breakout, correction, breakout, correction. Last Friday, we closed right at this pink line. On Monday, we appear to be trying to break out. So for the remainder of the week, if you're a bear, you'd like to see the VIX move in this direction. That would increase bearish concerns. If you're a stock bull, you'd like to see the VIX close below this pink line and better yet, below this blue line. So for the remainder of the week, we'll be watching this chart. We'll try to provide some updates on Twitter. The most important thing is how this chart looks as of the close on Friday. If it clears this area here, that's when our concerns really start to pick up steam about the S&P 500. Right now, it still looks relatively tame as of Monday's close. This is another chart that was explained in detail in last week's video, just an update. We were looking for AGG to make a higher high here above $110.66. You can see on Monday, AGG was actually down, which means from a risk-off perspective, there really wasn't much demand or fear driving demand for bonds. If AGG can make a higher high here, it would increase our concerns about a possible pullback in the stock market. If AGG reverses and comes down in this area, that's a good sign for the stock market bulls. In a similar vein to the AGG chart we just looked at, on Monday, March 25th, TLT was down. There really wasn't a lot of fear in the market or demand for risk-off assets. If you're a stock market bull, that's what you want to see. You want to see TLT come down in this direction. If you're a stock market bear, you really need to see some demand for TLT, and it's got to start moving up in this direction here. This is another chart that we described in detail in last week's video, just an update. This is risk on divided by risk off. When the ratio is rising, the stock market here tends to do well. Point of the exercise was at this resistance level here for the ratio, when it was rejected and moved away from resistance, the S&P 500 corrected. Right here, same resistance line, moved away, S&P 500 corrected. We're still stalled and battling around this general area. We've been below resistance for 2 weeks now. As long as this ratio remains below these trend lines, we will somewhat be tepid or concerned or hesitant about taking risk. If this ratio can break out into this area, we'd be much more open to redeploying some more of our cash. This is another chart we described in detail in last week's video. Here, when this ratio, the same ratio, SPY divided by IEF, stalled at this pink area of resistance in 2011, the stock market consolidated and eventually corrected. In 2013, we're again stalled and hovering near the pink trend line. If you're a bull, you'd like to see this ratio close above the pink trend line, and better yet, in this area. If you're a stock market bear, you'd like to see this ratio roll over. Try to show some updates during the week on Twitter. We'll be watching this chart to manage risk over the next few days. You can find that video by visiting the Shivako Capital channel on YouTube. Once you get there, if you scroll down, it will be the second video in the list here, and the name of it is Cyprus Stock Market Impact. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.